Brad Williams, Frugal Finance, mortgage origination fees. It should be apparent that the incremental borrowing cost concept is extremely important when describing or when deciding how much should be borrowed to finance a given transaction. In the preceding section, the two alternatives considered were fairly straightforward, with the only difference between them being the interest rate and the amount borrowed. As discussed earlier, in most cases, financing alternatives under consideration will have different interest rates as the amount borrowed increases and possibly different maturities. So the loan origination fees will generally be charged on the loan alternatives. This section considers differences in loan fees on two loan alternatives. Differences in loan maturities are considered later. The first case is the incremental cost of borrowing when loan origination fees are charged on the two 25-year loan alternatives listed in the previous course. For example, if a $1,600 origination fee, 2 points, is charged on the $80,000 and a $2,700 fee, 3 points, is charged on the $90,000 loan, how does this affect the incremental cost of borrowing? These differences can be easily included in the cost computation as follows. Differences in amounts borrowed and monthly mortgage payments. Same as above, but you pay 2 points origination. Here we have monthly payment on an $80,000 loan. 12% for 25 years is $84,200. We don't need to go through this. This is going to be a mirror of the previous discussion. And then the 13% on the 90. What is the true cost of borrowing an additional 10 grand is not 1%. It's this 172, 1015, 842 is 172.57. The question here is payoff. 80% loan in 5 years is 76,523. 90,000 is 86. Difference 10,117. Throw in a loan origination fee of 1,600 and 2,700. The 80% true loan is 78,400. The 90 true loan is 87,300. The difference 8,900. The APR 2326. If paid off at year 5, 1905. You can go through and massage the information here. We've gone through this. What you're looking at here is just the incremental calculations. As we did previously, we want to find an annual rate of interest, compounded monthly, that makes the present value of the difference in mortgage payments, 172, equal to 8,900, or the amount of loan proceeds received. Using Excel, we can find that the exact answer is 23.19%. Hence, the marginal costs increases to about 23.3% when the effects of origination fees are included in the analysis. The results from the fact that $1,100 in additional fees are charged on the $90,000 loan. Thus, the borrower only benefits from an additional $8,900 instead of 10 grand. If the loan is paid off before it's due, the added cost of borrowing goes up. If, in this case, as mentioned earlier, if the loan was paid off after 5 years, the added cost would bump up to approximately 24.67%. Brad Williams, Frugal Finance. Thanks for watching.